Joining us in studio now to share his analysis on the day's market performance is Jordan Toy from Legacy Family Wealth. Jordan, thanks so much for your time this afternoon. Now, it's really been a busy week from, the US-China trade truce. We've also had Trump visiting the Middle East and some investment deals being struck when he landed in Saudi Arabia. We also saw those softer inflation numbers also coming through, and that really boosting market sentiment. However, from about yesterday, we saw a pullback in markets. We are seeing some profit taking happening. Is this something to be concerned about, or are we just, awaiting fresh market catalysts?
Certainly, I think it's sort of, for me, a good example of the ebb and flow of sort of markets and sentiment, right? So it's quite clear that we're still likely to be in a worse position than we were, say, a year ago in terms of tariffs, right? So yes, it's sort of short-term relief and some positive news that we had in terms of the US and China, that sort of tariffs have been scaled back, at least in the short term, remove some of the uncertainty there. But for me, it's a great example of some of the behavioral biases at play. And I mean, from the average individual to professional investors, we're all subject to these biases. And anchoring, I think, is a great example of that, right? So we sort of anchoring on the fact that we were at like 150% tariffs and now we're at 10%. Oh, it's much better. You have markets roaring higher. But, the anchor point should be before tariffs were in place. And as I said, we're likely to still, I think Scott Bess, the Treasury Secretary, mentioned that, anything lower than 10% is unlikely. I mean, we saw them crowing about the UK-US deal being sort of a great deal, and yet we're still at sort of that 10% tariff level. So if that's kind of the best case scenario, then I think we have to frame everything else in that context. So certainly a bit of mixed trade today, a bit of that sort of positive wind maybe sort of falling out of markets at the moment, and as you say, maybe waiting for that next catalyst.
And what have you made of the JSE's resilience? Bringing in the rand to the conversation as well. It really seems like local markets are steady, the rand quite strong against major market currencies. Is this just on the back of, the gold price? Even though we have seen it pull back, it's still close to those record levels.
So the currency is always a tricky one, and I think you have to always look at the other end of the currency equation. So if we look at the rand dollar, obviously the dollar's been sort of on a strengthening trend for quite some time. Less so recently, we've seen the dollar weaken somewhat. If we talk, and you talked about you talk about gold miners, right? And you mentioned Afrimat earlier. I think that's also key, right? We're still battling with the logistics constraints. Can these miners, they can pull the minerals out of the ground, but can we get them out of the ports and to their customers? So, certainly those exports helping, but, likely, and I know Afrimat was talking about it earlier, they're not getting the full capacity utilization out of their allocation on the rail lines, and likely similar across all of our miners. So, gold price certainly helping. Are we capturing the full benefit? Most likely not.
And talking about capturing the full benefit, let's move over to some of the other company news out today. Equitus out with numbers, and they've really posted good earnings, to be quite honest, at the upper end of their target. But I see that the share price is down. The last time I checked, I think it was down over 1%. Is this a reflection of what markets are making of the numbers, or is it just on the back of the downbeat sentiment?
I think a good example of how tricky it is to try and anticipate market moves. So, as you said, I think a pretty decent set of numbers out of Equitus, but it can be a case of, we saw the numbers on screen just a moment ago, sort of the entire JSE across the board, mostly down. So I think that's likely the prevailing force behind that move. But Equitus, as you mentioned, a decent business, sort of the only specialized logistics real estate investment trust on the JSE. Naturally, it's in the property sector, so that sector has faced some headwinds in the past, specifically sort of the lows we saw around sort of the COVID era, and pleasing returns since then. So if you look at sort of the 1 and 2 year numbers out of the property sector more broadly, strong results there, but obviously off a low base. Having said that, I think Equitus, in terms of their positioning, obviously all properties are not equal. We've got sort of the logistics space that they play in, very different to the office property sector, right? And when we were looking at this earlier today, I think that they are relatively better positioned in that sense that if we look at sort of the major retailers, a distribution or logistics facility is a need, not a want. Whereas for them, setting up their head office in sort of top quality office space in Sandton or Rosebank or Cape Town or wherever it might be is definitely less sort of high up on the list of priorities. So a number of things pulling in Equitus's direction. We saw also one of the standouts for me was the sort of loan to value ratio. That dropped somewhat, which is pleasing. You mentioned the distributions per share were slightly up. So all in all, I think a decent set of results, likely being pulled down on the day by the sort of prevailing sentiment across the board on the JSE.
And interesting to see, you know, that demand in logistics properties. I mean, Equitus's vacancies were practically at 0% for South Africa. And on the other side, you did mention, you know, the office class when it comes to property that really has been struggling. Yesterday, I spoke to the CEO of Dibula Properties, Isak Peterson, and he said that they are starting to see a recovery in that office property market. What have you made of just generally what we've been seeing in the office property market? We are starting to see some of the bigger property players kind of refurbish those office property spaces to co-sharing working spaces, some of them really acquiring smaller properties in the office market.
So certainly a difficult space to be operating in. I think less so, as you mentioned, less so than it was maybe a year or two ago. So quite a lot of factors at play there. So you've got this balancing act between sort of minimizing vacancy rates, but also being able to push up rentals. And one of those things over the last couple of years has had to give, right? You've either taken the approach of let's minimize our vacancy rates, so let's get tenants in our buildings. But on the back of that, then we saw quite a lot of negative rental reversions, so or at least flat. And you talked about sort of the turnaround. It seems like it's starting to move in the right direction, where we're seeing less negative rental reversions and vacancy rates somewhat starting to improve. But I think there's still quite a long way to go before we get to a better space. And I mean, the property or the office space largely is a reflection of the broader economy, right?
Yep.
If the economy is struggling, we're not having new businesses starting up that need office space, et cetera, et cetera. So there is that linkage where we kind of been plodding along economic growth-wise, and that's not exactly helping the office sector.
All right, let's hit pause on the conversation. Before we move on to your stock pick, let's take a moment to touch on some counters that have been attracting interest from your industry peers.
Looking at an ETF, which is our shares, aerospace, and I think defense stocks. It's mainly focused on America and that, but it does give you an exposure to companies that I think that will benefit. I know Rheinmetall in Europe looks very strong and has done very well, but it is an area where we're going to see a lot more expenditure.
We've been talking about the discount in Naspers and Prosus relative to its underlying holdings for years, but effectively Prosus and Naspers have traded like proxies to Tencent for a very long time, and management has been trying to narrow that discount by buying back shares and selling down Tencent and buying more shares. But the reality is that the only way you're going to narrow that discount is to actually extract more value from the other underlying holdings, the other portfolio investments. And they've recently gotten in a new CEO, and it just seems to have energized employees and energized activity within that Prosus stable. They're doing stuff. There's some proper portfolio management going on. There's a listing of some of the underlying holdings going on. There's expansions. There is acquisitions. There's just activity there. And I like that energy, because I think that's how you're really going to start seeing a narrowing in that discount. Further to that, if you look at tech globally, Prosus is probably one of the cheapest big tech stocks you'll find. It's got Europe. It's basically a European tech. It's the largest European tech company.
So Chantal going with Prosus, Naspers, and David betting on the aerospace and defense industries with that iShares ETF. What have you made of those counters?
So I'll start with Chantal's first, and I've talked about Naspers and Prosus recently. She, touched on all the key points. I think the discount to net asset value is sort of a key focus for the CEO there. He is still relatively new to the position, the CEO. I think he's been in this, the role about 10 months, so not brand new, but still finding his feet. And, you know, she also mentioned the sort of operational turnaround and the, I suppose, trying to work on the culture within the company. In his recent letter to shareholders, that was a key point he mentioned. We'll see. It's a sprawling business, got lots of different investments sort of in the e-commerce space. Food delivery specifically is something that the CEO has experience in. So we'll see how how those businesses progress. But I think a darling of the South African stock market. Moving on to David's pick. Defence is a sector that I like more broadly. Specifically, the iShares ETF that he's talked about. You know, it's a very easy vehicle to get exposure to the sector as a whole. You know, iShares ETFs are very cheap, very diverse. So just looking at some of the holdings you've got, sort of from the aerospace sector, from Boeing and Spirit Aerosystems, all the way to, you know, your typical defence contractors, Lockheed Martin, RTX. So I think a sector that in the long term is not going anywhere. There was some concerns around defence, and I'll talk to that more broadly in my stock pick, but there were some concerns around when Trump came in about defence cuts. But, you know, there seems to always be uncertainty in the world and unfortunately conflict at one place in the world at one point or another. So I think defence is not something that's going away anytime soon. And the iShares ETF is an easy route to get exposure to a broad basket of those defence shares without having to make stock-specific calls.
Now let's get into your stock pick. You did mention that you are choosing a stock that has some exposure to the defence industry.
Yes, so I've talked about it many times before, but I think it's always an opportunity to talk about a new aspect. So Palantia Technologies, it's had a really great run over the, year to date as well as over the last year. It's sort of made it into some of these bigger indexes. What I thought was quite noteworthy was we talked about Trump's trip to to the Middle East this past week. He's actually still there. And he brought with him a number of top executives from the US, sort of from AI to finance. I mean, Sam Altman from OpenAI was there. But one of the CEOs who was also there was Palantia's CEO, Alex Karp. And I think that sort of touches on both areas. Obviously, we had an announcement in sort of defense spending.
The arms deal.
Exactly. So I think sort of straddling both the AI side of things as well as defense. Palantia is a company that specializes in AI, and, you know, we looked at it in February and they took quite a big knock when we talk about that potential cut to US defense spending. And I think it's actually it's a well-positioned company because it's sort of one of the first real use cases or early use cases of government starting to embrace efficiencies that can come out of AI. So in our view, we want to keep a close eye on it, but I think that Palantia can bring a lot of those efficiencies to the US Defense Department. There's a number of contracts there. So to really show that, okay, can we bring those efficiencies and cost savings through using these sort of smart AI systems in the defense space?
Jordan, thanks so much for your time and sharing your insights on Business Lunch this afternoon. That was Jordan Toy from Legacy Family Wealth.